2022 was a failure for the stock market and crypto alike, so how do you invest in the stock market in such a situation? Everybody knows that the best way to make money on the stock market is to buy low and sell high at higher and higher prices. No one should be surprised by the fact that most investors lose the most money when they try to buy cheap during a bear market. When the stock goes down even more, the stress and pain become too much for them to handle, so they give up and take a big loss. The buy low strategy has not just one but two major flaws. First of all, we have no way of knowing if the current low is the lowest of all time. In a bear market, support is useless, and it can be hard to believe how far a good stock can fall before it finds its bottom. The second problem has to do with how we feel. If our entry point is weak and we start to lose money, all of our preparations will be for nothing. Mike Tyson once said, "Everyone has a plan until they get punched in the face," which I think says it all. When the market makes us feel bad, our emotions come out and we often make decisions that aren't in our best interests. How should we deal with bad timing and negative emotions in a bear market? The good things about making probing buys. Testing buys are one way to do this. Jesse Livermore came up with the idea of probing buys. Even though Jesse Livermore is known as one of the best traders of all time, he went bankrupt 3 times before he was 30. During that time, he also earned a lot of money. But because his investments didn't work, he lost everything in 1929 when the stock market crashed. Livermore made more than $100 million, which is the equivalent of almost $1.5 billion in today's money. In the end, he wasn't able to keep any of it because, among other things, he didn't follow his own rules. One of the things that bothered Livermore the most was that many of the big trades he lost could have been very profitable if he'd just acted a little bit differently. He built up his position too quickly and too much, and when it became clear that they wouldn't start right away, he couldn't keep it. In the bad market we're in right now, this is the problem that almost all investors face. It's possible that the trades will work out in the long run, but when the pain gets too much, their emotions will push them to find a way out of the situation. Livermore found a way to solve this time problem by coming up with a method called probing. Instead of making a big investment at first, he'd buy only a small amount at a time to see how the market worked. This would help him understand how the prices were changing. If he liked it, he would be moved to buy it. If he didn't like what he saw, it wouldn't be a good fit for the job. George Soros says, "It doesn't matter if you're doing it right or doing it wrong. What matters is how much you lose when you're wrong and how much money you can manage to make when you're right." This is a favorite trading quote of all time, so let that one sink in. There are many benefits to the probing method. To start, it's easier to keep your emotions in check if you go slowly and start with a low level of danger. Once you actually own a piece of stock, your opinion of it will change very quickly and in a big way. When you look at a chart for the first time, you should usually skip it if it looks like it has too many details. But once you buy a small amount and watch how it moves, your opinion will change as you watch the price action more closely and get a sense of the stock's character. This will happen after you've finished making the first purchase. You shouldn't count that as a lost trade. Instead, you should keep going to keep an eye on the chart and wait for a chance to make your move. When you trade in small steps, the probing strategy gives you a lot more room to be aggressive. This is the second benefit of using this method. Because you know how to handle risks better, you can take bigger positions while still keeping an eye on how things are going. Livermore had 2 main things in mind when he was looking to buy something. First, he figured how much of a position he wanted to hold in the end if the stock kept going in a way that pleased him. He had a plan and didn't just buy shares at random like a random process. His first exploratory purchase would usually be about 20% of the size that he planned for the whole thing. The goal is to go into the price action with a plan and resist the urge to change that plan based on how you feel as the price action goes on. This first rule is tied to the second rule, which says that you can only take part in the deal if it turns out well. You don't try to lower your cost basis because you believe that at some point in the future, the market will see the value in this stock's good fundamentals. You should increase the size of your position as the price action shows that the market is starting to understand the value of the situation. This is a big part of how your timing gets better. You are not trying to guess how a stock will move at any point. You accept it even though it moves and does the thing it was made to do. Most changes in stock aren't random and don't mean much. You can use it as long as you keep an eye on the situation and think about it in the context of the market as a whole. You should think of volatility as a friend, not an enemy. Let's add to the probing strategy that you like to trade a part of the trade using shorter time frames. You won't think of it as one big deal that got bigger over time. Instead, you'll see it as a series of smaller deals that happened over a longer period of time. This strategy has many of the same benefits as the probing strategy, but it also helps to limit risk when there are fast flips while you're building a position. You can break down the probing method into these 4 steps. 1. Decide where you want to start. The most important thing to keep in mind is to keep it simple and leave room for more as the stock grows. When you're in a tracking position, which Jesse Livermore called a probing position, you'll have to pay more attention to how the price moves. This will help you get a better idea of the overall direction of the market. After you've bought some shares, you'll have more reason to do more research and look for both positive and negative catalysts. Number 2, look in the list for a second item. If the stock didn't do well from the beginning, you should sell it and move on. You might think about doing that at some point in the future. If it's doing well and the market conditions are good, you should add more. Use the volatility that happens often to your advantage. As long as the chart is in good shape, it really doesn't matter if you buy below or above the current price. Number 3, exercise your patience. After you've made some progress with the stock, the next thing you want to do is watch how it acts. Will that law continue? In that case, you probably would be happy with a partial sale. The longer you think the low will last, the more likely it is that you will make more small purchases. Number 4, keep your sense of being in charge. Reduce your risk and try again if the price action moves in a bearish direction and support comes into the picture. Don't just sit there and hope that the deal will go through. If the price action is getting worse, you should cut it soon. Even in the worst bear market, most probing trades won't be successful at first, but this plan lowers your risk and allows you to try again and again until things start to work. Thanks for watching this video. Stay tuned for more.